True tax planning is not how much money you can save in 1 year, but how can you save the most amount of money over the course of your life. When you convert over to a Roth IRA, you will have access to that money before you're 59 and a half. Sometimes referred to as a Roth conversion ladder, or the early withdrawal rule is when you convert over to Roth IRA, 5 years after you convert, you can actually access that money tax and penalty free. A lot of people don't know that. Welcome back, everyone, to the Learn Like a CPA show. I'm your host, Ryan Bakey, and today I'm doing the second version of my Roth IRA podcast. In the last podcast of the Roth IRA, we talked about when to contribute to it, how much you can contribute to it, why do you even need it in the first place, what are some pros, what are some cons. And in today's episode, I thought I would dive a little bit deeper on when is the best time to convert to a Roth IRA. So when you convert to a Roth IRA, you're going to take money that was in a traditional 401k or a traditional IRA, and you're going to convert it to a Roth IRA. Now, when you convert, you are paying taxes on the conversion. And I want to make this very clear and just kind of outline some guidelines here is that when you have a traditional 401k, that's money that you've already gotten a tax deduction for. So let's say I have $50,000 in a traditional 401k, I've already gotten tax deductions on that money. Now, when I convert to a Roth IRA, I then pay taxes on that money in order to convert it. But guess what? It earns and grows tax-free for the rest of my life. So if I am contributing to that at a 30% tax rate, I'm getting deductions on 30%, and then I find myself in a lower tax rate in the future, that's going to be when I want to convert over to a Roth IRA. Now, a couple of rules when it comes to conversions. The number one most important thing to know is when you convert over to a Roth IRA, the custodian is going to ask you if you want to withhold taxes. No, you do not withhold taxes when you do a Roth IRA conversion. And here's why. Two reasons. Number one is when you convert over to a Roth IRA, you have to pay taxes. Okay. But those taxes can be taken out of your Roth IRA. But here's the problem. If I have $10,000 and I convert to a Roth IRA, well, they're going to take the taxes out of that $10,000. So instead of having $10,000 earn and grow tax-free for the rest of my life, well, now I'm going to withhold taxes on that. Now only $8,000 is growing tax-free for the rest of my life as opposed to $10,000. So never, ever withhold taxes on a Roth conversion. The second reason is that when you withhold taxes on a Roth IRA conversion, the IRS actually treats that as early distribution. So that money that you withhold on your Roth conversion is going to be subject to the 10% penalty for early withdrawal. And a lot of people don't know about that. It's very important to understand. So when you convert over to a Roth IRA, do not withhold taxes. Okay, let's talk about when the best time to convert to a Roth IRA is. Number one, first and foremost, is anytime you have what I call a shock and income year. A shock and income year can be, let's say you're married and one spouse loses their job, or maybe you lose your job. And anytime your income is going to be down relative to what it was before or in the future, that's when you want to do a Roth IRA conversion. Maybe you got married and now your tax bracket is different because you're taking advantage of those married filing jointly tax rates as opposed to single. So number one, shock and income year. Number two example of when you would want to do a Roth IRA conversion is if you are buying a lot of real estate. Okay, a lot of our clients who buy real estate are going to be able to use those losses to offset any income. And part of the income that can be offset is retirement conversions. So we have clients that will go buy real estate. They will do cost segregation studies. They will have a lot of losses in real estate, and they can use those losses to offset a retirement conversion. An awesome strategy because now you're really taking advantage of the tax code, because true tax planning is not how much money you can save in 1 year, but how can you save the most amount of money over the course of your life? And that's what combining the investing in real estate with converting over to Roth. Another little side note on that is that when you convert over to a Roth IRA, you will have access to that money before you're 59 and a half. And that's what's sometimes referred to as a Roth conversion ladder, or the early withdrawal rule is when you convert over to a Roth IRA, 5 years after you convert, you can actually access that money tax and penalty free. A lot of people don't know that. So number one would be anytime you have a shock in income. Number two would be anytime you're tax planning around real estate. The third time you would want to convert over to a Roth is anytime you're if you're going to be in a high tax state in the future. So for example, let's say for some reason I live in Florida or Tennessee or a low income tax state, and then I want to move to a higher tax state, you'd be better off converting over to Roth now when you're in a state that doesn't have any income tax or a low income tax versus in the future, because once you move to the state that taxes income at a high level, now you're going to have to pay more money when you go to withdraw that, when you go to convert that over to Roth. So that's just something to think about. What are you doing in your life scenario that could cause you to pay more in taxes? And moving states could be one of those things. The other time you would do Roth conversions would be anytime the stock market's down. And the way that this works is, let's say I contributed $10,000 to a traditional 401k or a traditional IRA, and I was in a 30% tax bracket. So I got a $3,000 deduction for contributing to that $10,000 401k. Now, if my stock, let's say the stock is only worth $8,000 now because the stock market's down. Well, when I convert to a Roth IRA, I'm only paying taxes on $8,000 as opposed to $10,000. So the number of shares that I have doesn't change. I still have the 8,000 shares. What does change is I'm only paying taxes on 8,000 as opposed to 10,000. So I have the same amount of shares. I have $10,000 worth of shares. I have 100 shares of Amazon. And then when I convert it over to Roth, I'm only paying taxes on $8,000. So those are sort of when you would want to do a Roth IRA conversion. Another important tip I would say is, in the future, you really want to make sure that you're building these buckets of income that are either tax-free, which is a Roth IRA retirement, a tax-free retirement, or at the bare minimum, a tax-efficient retirement. So a tax-efficient retirement is having a lot of money in taxable brokerage accounts, real estate, any assets that don't really earn you money, but it's a wealth-building asset, along with a tax-free retirement. So you have your tax-free bucket, which is going to be your Roth IRA, Roth 401k, and then you have your tax-efficient bucket, which is normally going to be real estate and holding stocks and bonds. So thanks for tuning in to today's show. If you want to learn more, check out the Tax Strategies for Real Estate Investors Facebook group. We have over 10,000 real estate investors in there engaging and posting daily.